Hello people, this is Dr. Wang here recording. In this video clip, we are going to enter a new domain of capital budgeting, which will last till the end of the semester. On Canvas, you can see there are a lot of files and assignments for you. Capital budgeting is definitely a major topic of corporate finance. And not only we need to analyze how the cash flows are constructed, but also we will incorporate the risk factor in the budgeting process and how to hedge those risks. So we will work on some textbook cases like the Boeing case, Aurora. Both companies are in the Great Chicago area, and also we will do studies on target, and you will write a report on target. Since the video links are not good anymore, and I'm hereby removing the assignments for the videos. And also for some other case studies, you will need to do case 24 and 26. Case 26 is a company in Singapore. All right, so if you look at the Canvas files, you have two PowerPoints which come from the principal class. I put them here to provide a guidance of how to do capital budgeting, but I will not spend too much of the time to address this basic knowledge. Nonetheless, I need to show you some of the materials of the. Nonetheless, I will show you how to conduct the capital budgeting. How do you extract information from the textbook cases, especially when you are reading pages and pages of a context? How can you get the most valuable information and put them in your calculation? All right, so this is a capital budgeting chapter, and what you need to find through the textbook for a case. Let's say if you are looking at this case for Start River Electronics, so you need to work on the exhibit 4 of the case in your textbook. If you check the files, let's see, right here is a photocopy of the case. So this is just an example of what kind of a scenario you are facing if you are doing my cases. We're not doing it right now, but you do have to be aware that doing these cases, you need to conduct a lot of reading, and also you need to brainstorming and extract the right information. All right, so what information do we need here? You need to know what's the initial investment, okay, initial investment of your capital budgeting. So usually it's a big lump sum investment to buy the equipment, to buy the property, to start the project. And the capital budgeting usually is about setting up a new production line, okay, a new production line or a new business, okay, or you may need to replace a existing business with a new one, okay, or you may replace an existing line of production with a new one, replacing an existing machine with a new machine, which costs less to maintain and to fix the defects. All right, so for initial investment, definitely you need to buy the production, buy the equipment for the new production. You need to buy building for the new business. So this is also called a capital expenditure. All right, let's see, our capital expenditure here is $1,000. If I want to start a food business, let's say just buy myself a small cart and sell my some Chinese spring rolls on the Michigan Avenue, fictitiously speaking, I need to buy my equipment. Okay. okay, all the utensils for cooking, and also a cart for me to travel with, to carry the food. Okay, so this is a very easy part to understand. Aside from the initial investment, I should also calculate my operating cash flow. Okay, operating cash flow. And you see, this is the keywords here is a cash flow, which means if it's about depreciation, I will not count it in. So how do I count operating cash flows? So first of all, I need to make sales from my customers, either by providing my services or sell my final product. And then I need to deduct the variable cost, which is usually associated with the raw materials. And these two would give me a gross profit margin. Okay, let's say gross profit, which is a sales minus, just to put it here, the sales minus variable cost, and I will get gross profit. Okay, and then I need to deduct the fixed costs. Usually these are our rent, wages, utility bills, and indeed I do need to deduct the depreciation. Oops. This means minus. Okay, I do need to deduct depreciation. So although it's not a cash term, I will recoup it at the end. I deduct depreciation so I can get my operating income. Okay, operating income is the same as operating cash flows. Okay, operating income, what's the other name for it? It's also called EBIT, earning before interest and taxes. And then I need to deduct interest if this is to construct my interest. Then I need to deduct taxes. Well, the thing is, in a capital budgeting scenario, I will not count for all the interest. Okay, I will not count for all the interest because interest will be considered in the cost of capital and not in operating cash flow, average cost of capital. So I just delete this part. Okay, that's what normally people do in capital budgeting. And then I will have the non-depreciation net income, just to call it net income. And then I need to add depreciation into my result because depreciation is non-cash. I have to recoup this non-cash effect, and then I will have the operating cash flow. Okay, so this is the hardest part to compute. And then you also need to consider change of net working capital. But it should be really called the cash flow effect. Okay, the cash flow effect. So you should know that if your net working capital increase, I'm talking about inventory and accounts receivable minus accounts payable. So it's current assets minus current liabilities. Then if this net working capital increase, then your cash would be reduced. They should have a negative relationship with cash flow. And also you should have the salvage cash flow. So the salvage cash flow here would be just the money you get from the salvage price of the machine. And also you need to minus the capital gain tax. So if you sell the machine above its book value, then you make a capital gain, you have to pay tax on it. If you sell the machine below the book value, then you will make a capital loss, then you will receive tax credit for it. So, but this formula would stand. You can minus a positive or you can minus a negative as adding to a tax credit. All right, so this is what the outlook of capital budgeting. So for our exercises in this theme, we will need to follow this standard. Let's see. Here, let me give you an example. If you are doing any of those textbook cases, you need to extract the information like initial investment. Let's say for my business, I put $1,000 in, and then for my sales each year, I will make $900, and then my raw materials or variable cost, or say cost of goods sold, is $400. So that's a pretty good margin for me. And also I have the fixed cost. Let's say fixed cost. Let's say that's a 200. Okay, that's how much I pay for my license. And then I need to deduct depreciation. Let's say it's 100. That's too much, 50. Okay, and then I will get my operating income. So my operating income is something I can calculate. So it is sales minus cost of goods sold minus fixed cost minus depreciation. So this is my operating income. And then I will not incorporate interest. Sometimes I do pay interest for the bank loan I borrowed, but in the capital budgeting, I will not consider the interest payment or any financial cost like paying dividend to my stockholders. I do not incorporate that in the cash flow calculation. And then I will immediately calculate my tax. So if my tax rate is 40% based on my operating incomes, and I'm paying $100 to the IRS. And then my net income would be whatever left over to me. Okay. Because I need to recoup the non-cash effect to get my operating cash flow. Then I will need to add a depreciation back to my net income. So that's how much money I make on an annual basis. All right. And for the salvage value or salvage cash flow, I could see I will sell my initial investment, the money I paid for my cart of selling the food. I can sell it for $200 to somebody else, and I need to know what would be the depreciation, the leftover of depreciation. In other words, ending book value of it. Okay, let's say this business has a length of 5 years. Okay, 5 years. So the ending book value after 5 years is $1,000 minus 5 years of depreciation, and each year you get $50 deducted. So I still have $750 left, but I'm only getting $200 from salvage of this assets. So actually, I'm making a capital loss. Okay, but still, I put the name as capital gain here, and I use the salvage price minus the ending book value. So it's like a rush sale. So I suffer a capital loss. One is a negative, it's a loss. And then I will need to get tax credit on it. So I still use whatever the number I have multiplied by the tax rate. So if it is negative, so actually that means I'm receiving tax credit. I'm not paying that tax, but still I will deduct this tax. So what will be my salvage cash flow? It equals the salvage price I receive, okay, and then I need to I need to receive this tax credit for the capital loss. Okay, so this is called tax on capital gain. Okay, and this is called a tax on income. All right. So what happens if my depreciation is changed in another scenario? Let's say if my depreciation is $160 each year. So after 5 years, then my ending book value will be 200. Okay, 160 times 5 would give 800, and 800 divided by 1,000 minus the 800 ending book value would give 800 total depreciation would give an ending book value of 200. So when salvage price match the ending book value, then my capital gain is zero. I pay zero tax on capital gain. So what happens if my annual depreciation this time is changed to 200? Then my ending book value would be zero. So on the book, my assets will be worth nothing. But still, I sell it for $200. I make a capital gain on it. So I need to pay tax on that capital gain. Then, besides receiving this $200 from the salvage price, I also pay $80 for the tax on capital gain. So my salvage cash flow would be 120. And for the change in net working capital, okay, it is usually based on the sales. Let's say I need to maintain an inventory, which is 10% of the sales. Okay, 10% of the sales. Okay, so that's $90 I need to put on my inventory. And how do I incorporate this inventory in my capital budgeting? Now I do need to draw this capital budgeting table from year 0 all the way to the 5th year when my business ends. So let me just use the current existing data. So my initial investment here, it is negative, whatever the capital investment would be. And then I would have my operating cash flow, just cash flows starting from year 1. Okay, that's 260. Okay, lock it. And also I have my salvage cash flow. That is the 120 here. So back to my old question, how do I do the change of net working capital? Well, this would involve some of the skills, like you need to know how much your inventory have changed. Let me use the inventory to just represent net working capital for simplicity purpose. You know, inventory is part of current assets and therefore is part of the net working capital. The change of net working capital, if I start the business, then my inventory would be from 0 to 90. So I need to build up that inventory. Then I would spend the money, which is negative 90. Okay, because when I freshly started my business, I want to have some product in my pocket, right? So then each year I need to maintain the same level of inventory for the sales in the next year. Then I need to maintain this inventory at a $90 level. Okay, that's on my assets. That's on my balance sheet. But does my inventory change from 90 to 90, then to 90, then to 90 from year 1 all the way to year 5? It really doesn't. Okay, so the change of net working capital would be 0 all the way until year 5. So what happens in year 5? I quit my business, and for all the inventory I have in my pocket, I just sell them off, and then I will get the money back. So how much inventory did I sell? Yes, I sell them at $90. That's my normal inventory level. So I would get a positive $90. So that's how I do the change of net working capital here. And then based on all of this, I would get a free cash flow. Okay, it's called free cash flows. So basically, that's a summation of all these 4 components. Okay. And then I need to gauge whether I'm making money or losing money in this scenario. Then I will need to calculate my net present value, aka the NPV. But what interest rate should I use? Let me say I have a WACC of 10% because to start the business, start to buy all the inventory and the raw materials, I borrow those money from a bank at 10%. Okay, there's no equity raised. I just borrow the money from a bank at 10%. So I will use a 10% to discount all of the future cash flows. So use this at 10% and then put them all here, future cash flows, and then add the first year cash flow outside the NPV box. So it looks like my NPV is a positive. I'm still making a life and have a $26 overall profit to distribute it to as a business owner. Well, it does not say I'm making $26 all the all the 5 years. The money I make perhaps is in the fixed cost. I pay myself $200 salary, so still I'm surviving. Okay, so this is just an example of a typical capital budgeting plan. And this is something you need to do for our case studies in the textbook in the future. I hope this is a good review and get you ready for more challenging exercises.